everyone, and welcome to Going Inside Utility Stock's biggest event of the year. My name is Roger Conrad, and I'm editor of Conrad's Utility Investor. The event is Edison Electric Institute's 51st Annual Financial Conference, held this year in Phoenix, Arizona in early November. And in this short video, I'll be sharing some of my takeaways from those few days in the desert. I'll also be sharing one of my top recommendations from the conference, and I'll show you how you can get access to my entire post-conference report. Let's start with EEI. Edison Electric Institute is the U.S. power industry's leading trade group. Every year, top executives from every major industry player, as well as most minor ones, get together to discuss their common business interests, as well as to meet face-to-face with the investment analysts who cover their stocks and bonds for the broader market. It adds up to an invaluable opportunity for analysts like me to get information firsthand that you simply can't get just from poring over numbers in a 10Q, which I do, listening into conference calls, chatting with other analysts, or calling investor resources. Let me give you an example. A year ago at the 2015 EEI conference, I got an early heads up that utilities had effectively won their long war with the solar industry. The CEO of a large solar company had basically showed up to make nice with utility executives, a sure sign that at a time of record solar energy adoption, utilities were making the money, not widely touted solar components manufacturers. Front and center in my post-conference report was a warning to readers to sell solar stocks, and as it turned out, it wasn't a moment too soon. That unfortunate CEO's stock has since lost nearly 70% of its value, and one of his biggest competitors, Sun Edison, has filed bankruptcy. Its shareholders will be lucky to get anything at all when creditors finally pick through all the wreckage. And I regret to say that a number of other solar companies are in a similar position. My buy recommendations from last year were a stark contrast. Let's take a look at the next slide here. EEI 2016, Utilities Big Event, which talks a little bit about what I expect to find out of these conferences when I go to them. The bottom item there lists our buy recommendations. One of the biggest one, or the best one, was Talen Energy, and that's a battery power producer that made a presentation there. It was impressive. They talked a lot about their assets that I thought were pretty well run, but a lot of people were just looking at them from the point of view of what was happening with wholesale power markets, which not a lot of good things were happening, and that was the case also for this year. So this company faced a lot of headwinds. But, you know, where there's value, there's often a buyer. And what happened with Talen Energy was the two private capital companies that had taken it public in alliance with a major utility just a couple of years earlier decided to bring it back in-house. So they made a really nice offer for the company based on our entry price. We managed to get about a 70% gain out of that stock. But it was about half of what that they IPO'd it for. So this conference gave me an opportunity to take a look at this company, meet with the management, decide what kind of assets it had, and how well it was able to stand up to what were pretty tough conditions there, but also to perceive the value behind this company. And like I said, the private capital owners who knew it better than anybody certainly did recognize the value, and they did take it back in-house. And we got a really nice gain. The average gain for these for the rest of the picks was about 36%. And if you take a look at the symbols there, maybe some of you are familiar with them. They're kind of a mix between household names and smaller companies. AES Corporation's a global power producer, nearly went bankrupt 20 years ago in the wake of the Enron disaster. But they've honed their balance sheet. They've honed their assets. Really pared back to, really, I guess, their best assets, you would say. They've gotten involved in a number of areas that I think have tremendous upside, such as energy storage. And as a result, they've been powering their earnings and powering their dividends, most importantly, to the tune of increases of roughly 10% a year over the past couple of years. Where I looked at AES last year and said, this company has been unappreciated. And since then, it has gained total return roughly pretty close to 30%. And just to put that in perspective, that was a half again as much as what the Dow Jones Utility Average earned over that time. Looking down the rest of the list, Black Hills Corporation, a small company based in South Dakota, had a lot of oil and gas production assets and was downgraded for having those. But it also just done what I thought was a really major deal acquiring natural gas utility assets. So they'd really reshaped the company, and I didn't think they were getting credit for it in the marketplace. If you'd asked me which was the most likely of these 5 picks to be taken over, I would have said Black Hills at the time. But they were not taken over, but they did give us a gain pretty close to 50%. NextEra Energy, this is the leading contract solar and wind power producer in the United States, and continues to grow pretty rapidly. It's a very good business. This is one I picked again for the strength of the business, which I thought was underappreciated, and also for the fact that they were poised to really benefit from the extension of tax credits that year for wind and solar. So that one's also up or in the 30% range. And then my final pick last year was Southern Company, very large utility, and I just like the overall solidness of the story. Dividend growth, plus a pretty nice yield, plus some really nice deals. I saw them as transforming their company as well with a merger with the Crosstown Atlanta Natural Gas Distribution Company, AGL. And they've since completed that deal. They've also been very successful buying natural gas pipelines. They now own half of the pipeline that actually services them, their gas utility as well as their electric utility. They're transferring their power mix from what was almost 70% coal just a few years ago. It's now an equivalent amount. Natural gas has really become their major fuel of choice there. They're building a couple of big nuclear plants. Really nice story there. I liked it last year, and it also did well over the past year. So again, this conference gives us analysts the opportunity to take a look at some of the bigger picture trends out there and actually uncovering them. You can see what's important to the companies, what's important to the industry, what kind of questions get asked, and then just some of these just sort of coincidental things. For example, the CEO of that major solar power company, which was actually SunPower, at that conference, and a decent company. It's owned about 2/3 by Total, the major oil company, so it's not in any danger of going bankrupt. But him just being there at that conference and the comments that were made and the fact that they were a co-sponsor of that conference really opened to me the idea that they were trying to get in good with the utilities there, who were their major business they were counting on to spur earnings. And the balance of power had really changed in that industry that in favor of the utilities. So again, made me more bullish on utilities and very bearish on many of the solar companies, which it was increasingly clear to me were just simply manufacturers of solar components and therefore had manufacturers' economics rather than technology companies' economics, which I think a lot of people mistaken them for. So a big trend I uncovered there at EEI 2015. And so, again, I came into 2016 looking to see what kind of reveals I can find there. And I did find some, as I'll reveal in subsequent slides here. Face-to-face meetings with company managements, very, very important. I mean, you just really can't overemphasize how invaluable these types of interactions are, getting your questions really answered. But also, you tend to discover things that you didn't know or didn't really know the questions to ask. And so as you're asking questions, more questions come to mind. Really no substitute for improving your depth of knowledge about individual companies. And, that enables you to, has enabled me to highlight some undiscovered gems. You saw the last year's list of companies. I have another list this year. Going to reveal one of those to you in just a minute. But companies like Talen Energy, not really a household name there. Black Hills Corporation, again, not really a household name there, but real outperformers last year and in a year where utilities actually did pretty well. Spotting trouble, again, the solar is a pretty good example, but there were also a handful of other companies that I saw trouble coming from sort of I guess a confluence of events. The kind of the fact that their sessions were mobbed, the fact that that there were some serious question marks that seemed to be more or less brushed over. People weren't paying a lot of attention to. These are the kinds of things that you can uncover at these conferences, and that's what I strove to do when I went to EEI 2016. So let's get into I guess one of the big reveals that that I had at that conference, and that is electric utilities shifting customer mix. And this next slide makes that point with a series of colored lines. Maybe if we went back a little further, we would see this trend even more accentuated. But I think this makes the point here, mainly that utilities have a new group of customers that are now taking precedence over everybody else, pretty much, or they are building their systems around. Might be a better way of putting it. Electric utilities historically, if you go back to when this business was founded, the big facilities or the companies themselves were often organized around a large industrial facility. The country was very big on manufacturing in those days, of course. That was really the driver of employment. And so you would see power plants located next to big facilities. Now, this still happens in many areas, and particularly in the chemical industry and in places in the country where you have a lot of flow of natural gas liquids or petroleum and so forth coming through. The Gulf Coast is probably the best example. And the local utility there, which is a company called Entergy, is really cleaning up in terms of rate-based growth as more industrial facilities locate there. But what this graph here shows you is that that's more the exception rather than the rule. In most places, those facilities that are really drawing most of the power demand are not big industrial facilities. They're big, what are called commercial facilities, and specifically things like data centers that are run and operated by large technology firms like Facebook, like Amazon, like Microsoft. And these are run on very different supply and demand fundamentals than a typical industrial plant. So it's really causing a transformation in the utility system. Now, again, this is an area that some people are thinking about. You see more things written about, but you really saw it full on at this EEI conference, in particularly in some of the panels, some of the co-sponsors. Technology companies really are becoming very, very important. And again, you see it with that red line, which is the middle, the importance of commercial customers as opposed to industrial, and even residential, which are a big part of the power mix as well. And so even at a time where, if you look at the line itself, each line here itself, you see kind of a volatile, demand for electricity didn't exactly go up every year, but it did go up every year for that red line in the middle, which are the commercial customers. And this next slide kind of makes this point why that's the case. Now, this is the annual demand for annual wireless cloud energy consumption in particular. And it kind of makes the point of how much our wireless revolution, the electrification of our economy, really the digitization of our economy has had an effect on electricity. And it's really a quantum leap in terms of demand from this particular industry. So again, this is where utilities are seeing more demand from, and this is how they're having to alter their customer mix. Now, what does this actually mean for the utilities? Let's take a look at the next slide. Utility growth strategy, sustainable longer term. And this is actually a slide from Entergy, which, as I mentioned before, is actually doing pretty well in terms of adding industrial load. And not only adding industrial load, but having that industrial load really add across its entire rate base, because as a big petrochemical facility is located in the state of Louisiana or in the state of the Gulf Coast region of Texas or Mississippi, or any of the states in that part of the world, people move to that area, so their residential demand goes up, so their commercial demand goes up, and it's been a really successful formula for Entergy. They just restored regular distribution growth, regular annual dividend growth, and I think they'll be accelerating that over time. Again, as this rate base continues to grow. But look where Entergy is looking. Look where what Entergy is thinking about in a presentation they gave at EEI. That's where the slide comes from to give attribution. Look where their focus is, and it's not just servicing these industrial facilities as they've done in the past and as they're doing successfully now. Really a rarity in this industry, given the trends. They're investing in a more robust and modernized grid. Again, this is a key demand of big technology companies. They can't handle frequent outages. They really can't. These data centers, that's millions and millions of dollars every time if there is any sort of outage. They need a flexible. Their demands are flexible, so they need a more flexible way of being billed, for example. And they're also very, very interested in renewable energy. So again, these are all demands placed on the utility that they need to meet. And if you see, how is Entergy looking at this? Well, they're looking at it as a growth opportunity, utility growth strategy that's sustainable longer term. And that means investing in a more robust and modernized grid in response to evolving customer demands. And you can see energy management, storage, home services, distributed generation, microgrids. Back in the day when utilities only cared about industrial customers, these were not real considerations. I mean, obviously, industrial plants didn't want to have outages any more than anybody else. But these are all, again, things that utility needs to modernize. They need to invest in. And most importantly, they have regulatory support to recover that investment. So again, this is how Entergy is looking at its world. This is a company that's one of the few companies that's doing well kind of in the old model, but they're looking ahead to the new model. Now, again, this is how they're thinking about it. An investment opportunity that will lead to rate-based growth, which again leads to earnings growth. So, again, it depends on regulatory support for effective recovery. But I think that, again, it's got to be they have to have support of that local community, but they do have it in a very big way. Now, this next slide here, U.S. Electric Utilities annual capital spending, kind of shows how the utilities are now thinking here going forward. Now, each one of these blocks here represents a place where utilities are making investment, and if you take a little closer look, you'll see the dollar amounts here involved. Now, the blue part of the cone there, this has always been the traditional part where utilities have invested most of their money. That's generation. Where's this generation going? It's going primarily to natural gas because natural gas generation is, first of all, a way that by switching to gas generation, utilities can cut their emissions. They can comply with various environmental rules and so forth, but they can also, by swapping coal for natural gas, coal primarily, they can run their plants a lot more efficiently because most of the coal plants out there are about 50 years old. It's the average age of many of these plants being shut down. Even the newer ones, 20, 30 years old. A new gas plant is implying, therefore, technologies that's about 20, 30 years more efficient. And, you don't have to be an engineer to realize that a lot's happening from just the manufacture of components, just how light things are, how durable things are, how efficient certain things are conducting, to know that a new facility is going to be far more efficient than an old one. And by running a new facility, companies can instantly cut their costs. So this kind of capital spending even on generation now, and you can see the other areas here: distribution, transmission, and gas infrastructure. All these things make the utility operation that much more efficient. And so you have good economics on that end. You also have good regulatory support. And this is the point, again, going back to that earlier slide about what Entergy was saying. Regulatory support is essential to recovering return on investment. Utilities obviously making a more aggressive bet this year than they even made last year. If we'd gone back further on this graph, you would see that a steady increase actually in capital spending. But 2016 versus 2015, um, a big increase in spending across the board, and with a lot of it in transmission, a lot of it in more efficient generation. That tells you something about how confident companies are that they can get that rate of recovery. And the next slide here really makes this point why they're more confident. And it's called regulator support moves. It's a map of the United States, and basically all the states where you see in orange and in light blue, these are states where there's a good chance that utilities make an investment, they're going to get recovery of that investment. The investment, again, in many of these states is to reduce costs, and that comes off right against customer rates. So it's very popular with regulators for a utility to make an investment, to reward that investment if that investment actually cuts rates or brings customer rates down. One of the speakers at the conference was the CEO of CMS Energy, which is based in Michigan. And this woman's a line engineer, and this is her main focus, is to reduce costs at every area of that enterprise. What can they invest in that will bring down those costs? By bringing down those costs, by making that investment in the state of Michigan, which, as this map shows, is a very favorable regulatory environment. They are getting their investment. They can make this investment, add it to rate base. It increases their earnings. They're able to increase dividends off of it. And at the same time, these investments are bringing down costs. So the utility is actually, in this case, not using more energy, maybe not selling more megawatt hours of electricity, but they are increasing earnings, again, by making investments that are helping customers reduce their costs and improve efficiency. And it's a really an awesome model of growth that's far lower risk than the model of growth in the previous building cycle of the 70s and 80s, where it was all about building big power plants. And it took a long time to build these plants. It took a long time to permit them. And while they were being built, interest rates were going up, costs of commodities were going up, labor costs were going up. So the final cost of a lot of these facilities was just blowing out the doors. And as a result, utilities had to write off a huge percentage of it when they finally went to get a rate increase. Well, this growth boom, if you will, is being driven by smaller projects that are cutting costs that can be completed quickly, and therefore they're adding to earnings pretty much right away. So there you have it. And as you can see, a lot of good positive regulatory relations in many of these states. Now, this is actually a pre-election regulatory map. And I think since the election, we have seen some very favorable movements in several of the states. Missouri is one of them. Oklahoma, another one that seems to be coming up in good shape. Also, a couple of other states that had been fairly hostile, Vermont, New Hampshire. There's some changes there, and a possibility that we might see a more favorable regulatory environment there. So even in some of these contentious states, or states that have been historically contentious to companies, you're starting to see, I think, a kind of a change in tone in regulation, and more importantly, better chance for utilities to recapture their return on investment. So this is a real takeaway from this a bullish takeaway, if you will, from this conference. And I want to share with you a company that I think is really taking advantage of that. Let's take a look at this next slide. And this is this particular company's investment plan. And as I've mentioned in previous slides, again, this is what the utility sector is all about: investment, recovering that investment, adding to rate base, and therefore growing dividends off of it. So this tells you this company's investment plan. It does not assume any clean power plan compliance investments being recovered in rate base. The Clean Power Plan very likely is a casualty of the recent election. And those of you who aren't familiar, this is the Environmental Protection Agency's plan to essentially dramatically reduce carbon dioxide emissions economy-wide. Again, this plan does not include that clean power plan that again looks to be dead, but it does include a number of investments in a number of other areas, and particularly transmission and distribution. Look at that, 36% of their planned capital expenditures are going to be in transmission distribution. Only 9% is in new generation. A lot of that's solar. They happen to be located in an area of the country that where that makes a lot of economic sense. They don't need subsidies there for it for these building these facilities. Which, one thing a lot of people forget is once they're built, there's no fuel costs. So the hard part is just getting them up and running. And once they're up and running, it's actually pretty economic power. But there you go. What their plan is. That 23% environmental pond closures. This is a pretty good reason why you're not going to see a lot of new coal plants, for example, regardless of what the politics are at this point. And that is that the existing coal plants, which have been, again, around for about 100 years plus, they have created this kind of major environmental challenge that utilities have to face, and that is coal ash ponds. Now, if you look at North Carolina, has been a pretty red state. It's I think it's probably at least as a purple state at this point. But they had a very conservative governor prior to this last election cycle, and at this time, Duke Energy, one of the major utility in the state, had a major accident at one of its coal ash ponds because when a coal plant generates ash as a waste product, it's stored in a more or less what's called a pond. And what happened here was there was a leak in this pond, and it leaked into the Dan River in North Carolina, and really kind of a scary situation in terms of what you find in coal ash making its way into the water supply. So Duke Energy since then has really been under fire to clean up its coal ash ponds. It has reached an agreement with the state, and but it is costing. It will cost them to take care of this problem. Southern Company, obviously, here, this is part of their plan here is to get rid of some of these ponds. So this company is Southern Company, and this next slide really talks about where all this investment's going. Again, Southern Company, big utility serving the Southeast, and just bought AGL Resources, as I mentioned earlier in this presentation, big gas company. So they're now a major gas distributor, as well as pipeline company, as well as producer of gas-fired electricity. They're also a major contract solar producer around the country. And, again, we have had a change on the federal level in terms of that's likely to bring a change in energy policy. But I think one thing a lot of people don't understand is that solar energy adoption, and particularly big contract power plant adoption, utility scale solar, in other words, in most of the country, has been adopted because of state mandates. So states like California, which is a very huge percentage actually of the U.S. economy. States like Texas with wind, are very much a red state. They are definitely continuing to support the build out of these very economic sources of energy in these states. Now, wind's not economic in the Southeast, and Southern doesn't use it as a result. But there is a good opportunity to build and produce solar energy. And again, even if those tax credits should go away, these existing plants have already taken the credits, and once these plants are built, they're pretty economic to operate, particularly as cost of solar panels continues to come down. Cost of solar panels down about 31% over the last 12 months. So that's really good for adopters like Southern. It's really bad for companies like SunPower, which produce them, and it's a result of extreme competition for solar panel producers. But again, very good for companies like Southern. And you can just see the formula here of how this is translating into dividend growth. Go back to the last slide. You can see where that investment's coming in. And then look at this slide. What are they doing in terms of dividend growth? Well, they're telegraphing here that they're accelerating that rate of dividend growth. They had been back early in the last decade growing that dividend at just 3% a year, or sorry, 3 cents per share per year. And they then began raising it at 6 cents per share. And the last several years, it's been, or really since I guess 2008, it's been 7 cents a year. They're now accelerating that. So what does that tell you? Well, this investment plan is working. Southern Company's dividend growth is accelerating. And one thing we see with these stocks is accelerating dividend growth. Dividend growth pushes that yield up over time. That pushes a stock up. And accelerating dividend growth earns a stock a higher earnings multiple. So this is my pick for you today. It's actually was one of the picks from coming into last year. I think this year will be the year where it maybe gets a little more credit. Again, thanks to that accelerating dividend growth rate. And I do have other recommendations in the full report, but I just wanted to bring out one more fact here for you. I know a lot of people, there's a lot of misinformation going on around about utilities. So I know a lot of you are probably saying, well, yeah, Southern's got a great growth strategy. I really like it. But, you know, I've listened to CNBC and, I read some of this stuff on some of the popular websites. And it's all telling me that any stock that pays a dividend, I should avoid because the Fed is now raising interest rates again for the first time in many years. And I know the bond market's collapsed, but now I'm really worried about these dividend stocks. So, thanks a lot, Roger. I really great for giving me this recommendation, but there's no way I'm going to buy it with the Fed about to raise interest rates. Well, this next slide, I think, should set your mind at ease, and it really kind of blows the lid off of this conventional wisdom that dividend-paying stocks are bond alternatives, and they should be avoided when the Fed has a tightening cycle. This graph here, and you can look at sort of at the dates. You can either squint at the bottom or you can look up at the top. The graph begins June 1st, 2004, and it ends June 30th, 2006. Now, why did I pick this period? Because it's the last time the Fed was on a sustained tightening cycle. We went from over this time, from the beginning of this table, from the beginning of this graph, the Fed funds rate was 1%. At the end of this graph, the Fed funds rate was 5.25%. So a lot of rate increases. Right now people have been talking about, the Fed's talking about 3 rate increases this year, and people are getting very excited about that. Well, that was nothing compared to what they did in 2004, June 2004 through June 2006, But this graph here shows the Dow Jones Utility Average over that time period. And as you can see, it was a great time to own utility stocks, this tightening cycle. In fact, the total return from beginning to end here, from the beginning of the tightening cycle to the end, to when they stopped, to the last interest rate increase, the Dow Jones Utility Average returned better than 60%, 60, better than 60%. What was the S&P 500 over that time? About 15%. So the Dow Jones Utility Average, utilities not only had a tremendous performance, but they outperformed the broad market by about 4-1. Why is that? Well, it's because these companies were coming out of a really bad period back in the 2001, 2002, when Enron collapsed and took down a number of companies with it. A lot of utilities actually tried to copy the Enron model. So what was coming out of that period was stronger utility earnings as they got back to basics, and their perspective improved. I'm arguing the same thing is happening here right now for utilities. Obviously, a great and as I showed you with Southern, a strongly improving earnings package for them going forward, and again happening at the same time that the Fed is raising rates. So again, this is a pretty good precedent for what happens when the Fed raises rates in a strengthening economy. And that's what it really boils down to here, folks. It's utility stocks, any other dividend-paying stocks, they act like stocks. If the economy is improving, if their earnings picture is improving, we can look forward to strong gains. We can look forward to higher stock prices. If the economy, on the other hand, is doing poorly, as it did in 2008, we can look forward to these stock groups falling. So The Fed raising rates is not something to be feared here. If the Fed is actually able to raise rates the way it thinks it's going to, and it will be because the economy is strengthening, which will be good for utilities. So again, good time to buy good utility stocks that have this accelerating earnings format. And I think, again, this is something that you're not going to hear from a lot of advisors, but I think this graph doesn't lie. Last slide here. I just want to tell you a little bit about where you can find. I would tell you where you could find out more about the full report. And the full report's called Inside Man. It's Roger Conrad's best ideas from the Edison Electric Institute's 2016 financial conference. It's housed on our website, the Conrad's Utility Investor website, for subscribers. If you become a member of Conrad's Utility Investor, we have 12 monthly issues. I have alerts, regular updates, live chats, special reports like this one. You'll have access to those. We cover 200 plus dividend-paying essential services companies in our coverage universe, buy, hold, sell advice for all of them, quality ratings for all of them, and a lot of financial data as well, such as true payout ratios. I think that's one area a lot of people get really sold down the river on, particularly with some of these larger services that are purely automated. They don't tell you what the real profitability of a company is. So a lot of times investors will buy something thinking the dividend is safe just because the payout ratio posted, which is dividends as a percentage of earnings, is a lot lower than it truly is. It might be including some one-time factors. It might be including something that's not sustainable. We get all the way down in there and find the ones that are sustainable. And again, that's kind of the key to whether companies are able to grow distributions. I have conservative, I have aggressive, I have drip portfolios. Again, they're informed by 30 plus years of experience in this business, which I have. And I hope you'll check out the product. If you click on the green button below, you can find out more. So thanks for listening, and hopefully check us out.